Warren Buffett once made a fascinating bet. He wagered $1 million that a simple S&P 500 index fund would outperform a collection of carefully selected hedge funds over 10 years. These weren't average funds. They were run by some of the most skilled money managers with extensive resources, research teams, and decades of experience. The outcome: the index fund won decisively, not because these managers lacked skill, but because beating the market consistently over long periods is incredibly difficult for anyone. If even elite professionals with every advantage struggle to do it, that tells us something important about how most of us should invest. So here's the question. If skilled professionals with every advantage find it this difficult, what's the right strategy for everyday investors? Should you spend your time researching stocks and trying to find winners? Or is there a simpler path that might actually work better? The answer becomes clear when you understand two fundamentally different approaches to investing and what decades of market data tell us about each one. Let's dive in. Let's start with active investing. This approach involves selecting individual stocks, looking for companies you believe will outperform, like finding the next Apple or Tesla early. It also means market timing, trying to buy low and sell high by predicting market movements. Active investors spend significant time researching companies, analyzing financial reports, following market news, and monitoring their portfolios regularly. The appeal is clear. Why accept the market's average return when you might be able to do better? With the right picks and timing, you could potentially outperform by a significant margin. It's an approach that attracts people who enjoy research, trust their analysis skills, and want more control over their investments. The question is, does it actually work for most people who try it? Now, let's look at passive investing through index funds. This is a fundamentally different approach. Instead of selecting individual stocks, you buy the entire market in a single transaction. For example, S&P 500 Index Fund gives you proportional ownership in 500 of America's largest companies: Apple, Microsoft, Amazon, Nvidia, and hundreds more, all at once. Index funds also charge significantly lower fees since there's no expensive management team picking stocks. When the overall market rises, your investment rises. When the market falls, your investment falls with it. The strategy isn't to outperform, it's to capture whatever return the market delivers with minimal cost and effort. And as we'll see, the data shows it works remarkably well. Now let's look at what the data actually shows. Over 15 to 20-year periods, research consistently finds that 80 to 90% of actively managed funds fail to outperform the S&P 500 index. These are funds run by experienced professionals with dedicated research teams and substantial resources. Despite every advantage, the vast majority underperform a simple index over the long term. Individual investors face even steeper challenges. Studies show the average person underperforms the market by 2 to 3% annually, often due to behavioral factors like buying high during euphoria and selling low during panic. In contrast, investors who simply bought index funds and held them captured the market's historical average of around 10% annual returns. The evidence is clear. For most investors, passive indexing delivers better results than active stock selection. Costs are where active investing quietly destroys your wealth, and most people don't realize it until it's too late. Actively managed funds charge you around 1% in fees every year. That might not sound like much, but it compounds into a significant amount. If you invested $100,000 for 30 years at 10% returns, an index fund charging 0.10% fees would leave you with about $1.6 million. However, the same investment in an actively managed fund charging 1% would leave you with $1.3 million. That's $300,000 you just handed to fund managers as fees. Active investing is exhausting. You're constantly researching companies, reading earnings reports, trying to figure out if you are missing something. Most people burn out or make emotional mistakes under pressure. But with index investing, you probably spend few minutes identifying a fund of your choice. You reclaim hundreds of hours of your life. No stress, no constant decision-making, no tracking your portfolio every day. Doing nothing gets you better results than putting in so much extra effort. Let's talk about risk and diversification, because this is where stock picking gets dangerous. When you own individual stocks, you're making concentrated bets on specific companies. Without full knowledge of companies' business, their balance sheets, economic uncertainties for the sector, you run the risk of losing large amounts of money. Index funds reduce that risk significantly. With S&P 500 index fund, you own 500 companies weighted by market cap. The bigger the company, the bigger your stake. As companies shrink and fail, they automatically become a smaller part of your portfolio. The index continuously rebalances itself, cutting losers and adding winners automatically. You're not betting on individual businesses anymore. You're betting on the entire economy's ability to keep producing successful companies. Over a long term, index funds have always proven to be wealth creators. So who should pick stocks? Honestly, it's incredibly difficult for anyone unless you are doing it full time. Professional traders spend their entire careers developing expertise, and even they find it challenging to consistently outperform. If you have specialized knowledge in a specific industry or extra capital you're comfortable putting at higher risk, individual stocks might make sense for a small portion of your portfolio. But for most people building wealth, the answer is clear: index funds. The reality is simple. You're competing against professionals with dedicated research teams, advanced tools, and decades of experience. That's a tough playing field. The good news? You don't need to compete. Index funds let you participate in market growth without needing to outperform anyone. It's not about being the exception, it's about being smart with a proven strategy that works. Here's the bottom line: index funds beat almost everyone on performance, cost, time, and risk. The data's been clear for decades. If you want to get started, it's incredibly simple. Just open an account at any major brokerage and buy a low-cost index fund of your choice. Then set up automatic monthly contributions. That's it. No drama, no complexity. Your future self will thank you.
Subscribe for more wealth-building ideas that work.